What's up, y'all? I just finished the last video promising you guys I would be on the charts right afterwards. So we are going to get into this right now. So this video is going to be a little bit... Oh gosh, what I do? Oh, I don't have my indicator on. This video is going to be a little bit advanced. Just a little bit. Just a little bit advanced. Towards the end of this playlist, though, with everything I've taught, I'm going to have you guys relearn it with more in-depth knowledge. So just grab what you can from this video and the next until you're able to reach the end where I can really put you guys back in the loop with telling you every very in-depth way of using all of these strategies, okay? And don't be discouraged. This will all come very easy the more you learn. Okay, so we are going to go to a semi-quality New York Open session because last New York Open was Thanksgiving fucking day and it's pretty chop. That was pretty chop. So SMT divergence. What is SMT divergence? Now, some may call this SMT divergence. Some may call this lag. Though lag is an understatement. Lag is lacking reason. So what I mean by this is SMT divergence is not lag. It's proof of possible correlation. So you're like, Karl, what the fuck are you talking about? I don't even know what this looks like on the chart. It's okay. I got you. So, SMT divergence, which is a point on one market and another point on one market not being the same, is very useful on a pair of markets. And a pair of markets that is not just a pair of random markets, but a pair of correlating markets. For example, NASDAQ and S&P. Now, quickly to get in depth, why are these two charts correlating together? Why are they a pair? Why do they work together? Well, NASDAQ stock is the top 100 US companies, and the S&P stock is the top 500 US companies. So, usually NASDAQ will be cleaner because there's far less and better companies inside of the NASDAQ stock. Now, S&P isn't going to be far off. When NASDAQ companies move the market, usually smaller companies in S&P, and by the way, they're not small. These are still very big companies. Those companies change or tend to change their ways. And also, S&P will then change into a different direction, okay? And overall, S&P kind of copies NASDAQ because the companies... every company's kind of doing the same type of thing, but just differently. So like when NVIDIA and Apple and all these major tech companies on NASDAQ are having big success. NASDAQ's moving up. S&P, the smaller companies in S&P are probably going to have the same type of reaction moving up. But forget this. Why SMT is used is because when we have a point touched on NASDAQ, for example, let's just move down, right? Let's just see. Perfect. So NASDAQ has touched this pretty prominent low. But what has S&P done? Not touched the prominent low yet. And as you can see, they are the same low. So basically NASDAQ has just touched this low and S&P hasn't. In the most simple form, NASDAQ is the better stock. Without even looking at it, you can see, too, it just looks cleaner today. So we not only have a cleaner looking stock, a cleaner looking chart than the other, we also have it being NASDAQ, which is a stronger stock. So what's most likely going to happen? Do you think S&P is going to come down or up? Now, since that was kind of a stupid question, Since we're so close to this point, the chance of us just touching it on S&P 2 is going to be very high. But let's say, instead of being this close, we were all the way up here. We most likely would not waste time moving the other chart down, but we would just move up, right? We grab liquidity on one chart. We don't need to do that on both. What's going to happen now is both charts are probably going to move up, right? If NASDAQ starts moving up from this point and S&P isn't that close, S&P will move up like NASDAQ. This is SMT divergence. Now, the difference between SMT divergence and lag is if market doesn't do anything, it just kind of continuates down or up, touching the other point to fix lag. It's kind of just lag. But then again, you could also call that continuation, which is why I don't like to use the word lag. Forget about lag. It's stupid. It's something that holds very little idea in it. SMT makes more sense, right? If NASDAQ touches this point and chooses not to move up and shows us proof, which I'll show how this works eventually, shows us proof that it's going to move down, and we have all of this room here in S&P to move down to fix this SMT or lag, whatever you want to call it, whatever, then we could maybe make a trade to move down. Or again, we can make a trade on S&P to move up if NASDAQ's showing proof of moving up after touching a point. Up or down, of course. So let's see what happens, right? Let's see if we can fix this point or if we can actually move up. I hope you guys don't hear. I'm at my father's right now, just before I move away. He's doing some construction, so pretty annoying. Well, look at this. We have just moved up. Maybe not for long. We haven't really inversed this fair value gap right here. So we could just keep going down. Or it could be a retrace. So basically right here, it's pretty much like showing us it's not going to move down. Right, and there's no reason for me to actually place an SMT because NASDAQ's showing better price. Why you would use this is, if there's a chart that's better, but one chart hasn't touched a point, but the other chart has touched the same point, you can mark it as SMT and still manage to place on this chart. Or if you only are going to place on a single chart, and that chart doesn't have any points it was touching, but NASDAQ or the other chart did, and they are the same points, there's your advantage. You can now use this chart. So let's just say, NASDAQ has better structure, but for some reason, I want to place on fucking, I want to just place on S&P. Well, because NASDAQ swept this low, and is showing pretty much solid proof that it's going to move up. Fuck it. Let's place a trade. Now, this is not something I would ever do. This is low probability. It's just a 1 minute low being swept with a small little inverse, tiny retrace, right? So obviously we're consolidating like shit. Don't worry, it doesn't matter. But looks like, yep, see, then we fixed the low. And now what's probably going to happen is we're going to move up. And check this out. So we fixed and corrected SMT. We on S&P have a lower low. But now on NASDAQ, we have a protected low, so a higher low. This can be very useful. If we can inverse this fair value gap, I could use this. Whoa, look at that. Retrace into this, okay? And we inverse this fair value gap with a protected low. which means market is less likely to move down again, since we've basically formed a trend. Well, a quality trend. I'll put my stops just on the bottom of the candle that created this fair value gap we retraced into. And okay, well, again, boom, 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 boom. Did price move even close to this point? No. Perfect. Look at S&P. You can't even read this chart. It's so bad. So in quick, I think I'm trying too hard to explain this in simple terms. So I'll chill out with this. But basically, SMT divergence is when you have a pair of charts that correlate with each other. And the only charts I teach you to use are NASDAQ and S&P because they are fucking superior to every other chart, in my opinion. You have a pair of charts that correlate with each other. And one of these charts, any chart, touches a high or a low without the other chart. Okay? If there's proof of the chart that touched the point prior to the other chart touching, moving up or down, you have enough proof that both charts may be moving up or down to place on the chart that doesn't have the point, that doesn't have, you know, the low or high being touched, that doesn't have enough confluence for you. So now you have both charts available to trade up or down, depending on whatever this is going to be for you. You have double the chance of placing. If NASDAQ doesn't give you an entry with the point, but S&P has SMT divergence and has an entry, place on S&P. Does that make sense? And you can use this in many other ways too. Like, let's say we are on NASDAQ and S&P on the 5-minute time frame. Okay? And I don't like to use this as much. I think it's a bit more sketchy. There's a 5-minute fair value gap on each chart. Okay? It's the same one. Look at both charts. The same one. NASDAQ has better price action and just swept through it, inversing the fair value gap. S&P did not. Some people would place a trade on either chart based off one chart going through a 5-minute fair value gap or some confluence of any sort. So let's test this out, right? Let's see what happens here. Maybe, maybe this happens. And I don't trade like this for a reason, because it's kind of cooked for my strategy. But I'm just trying to show you proof. Like, okay, clearly that did not work. Maybe we move up eventually, and it's definitely not because of the 5-minute fair value gap all the way over here. But you get the vision, right? You understand the vision. Now, when we get into later concepts and putting stuff together, and when I reteach you guys this after you learn all of that stuff too, this will come into your mind so very easily. Okay? So this is just a very quick representation. I'm going to show you one more SMT divergence, but what I'm going to do is make it a little bit more hard. I'm going to show you SMT divergence on the 1 hour. Okay? This does work like every confluence, and I've said this before, on every time frame. All of my confluences work. And they're not my confluences. People use these all over the world, but they work on every time frame. So, holy shit. This is chop, isn't it? Wow. Oh, gosh. Let's hope for the video we can come to one of these highs or lows, these London session highs or lows, before the other chart. So I can show form of 1 hour SMT. Okay, so here we are. I am going to wait for one of these charts to touch one of these highs or lows. Whole bunch of... Okay. Please let me be lucky. Oh, fuck, guys. Okay. Well, in this case scenario, both charts touched it. But aha! Aha! Look at that. Look at this. So, in this example, since we just touched a point and another point in one candle, I wouldn't really use SMT because we just grabbed liquidity up here. We're probably going to move up. Probably not going to fix it. And we also don't need it because we have liquidity here. But S&P grabbed this low, but NASDAQ did not grab this low. So if we didn't have these points down here touched, we would have SMT. Okay? We would have SMT. Now, even with us grabbing these lows, let's see if we do move down to just grab these on NASDAQ too. Looks like we are going to grab these. I mean, look at, okay, in my market intuition, if we come all the way down here this close and then move up a little more, there's no shot we're not going to come back down here. We're usually never going to just go up. We just moved from here up and then down even closer. We are going to pretty much move down. So let me just, for some dumb reason, place a stupid trade showing you guys that I'm probably correct. Without embarrassing myself, please. Okay, great. And again, it's 6:40 a.m. This is when nobody's at their desk making price move. This is when no good price is ever on the markets. So, market open, this does not happen. But basically, if we didn't have these lower points, right? If we didn't have these London lows and we just had this SMT, you could have easily placed a long on NASDAQ even without it touching any of those lows. SMT, baby. I mean, holy shoot. Look at this, bro. Fucking could have placed like right up here. Obviously, you would have been raped. Let's say you found an entry down here. And this is 6 a.m. So all the price is going to be absolutely dog shit. Let's say you were right down there and you placed. Targeted these highs. You could probably make a lot of money. Boom. Boom. All because of SMT, possibly. So I don't want to confuse you guys anymore, really. Take what you can from this video. Seriously. Take what you can from this video and move on to the next. Like I said before, towards the end, I will be helping you guys actually put things together, which will make you far better at trading, and then reteaching most of these subjects in also more complicated ways and terms, and you will be able to learn it far easier than the first video you watched in this playlist. With that being said, I'll see y'all in the next video. Peace out, y'all.